Okay, now, so I can see you're getting very good grades in the assignments. Uh, I wanted to go through the assignment, just another version of this with you so that you have an idea of how this looks like. So is there any question in the assignment that you have, any problem that you ran into and were unable to resolve the issue? And also remember that every student gets a different version of the assignment, so it's not the same, okay? These numbers will change for everyone. Okay, so just a quick run through the assignment, even if you've done it or if you're still trying to resolve it. I have this Excel sheet, and it's pretty much this very similar assignment that you've got for chapter 3. So let's run through this very quick. And in order to save time, I have already solved this and I've got the answers, but I'll just run you through this. Now, this is the balance sheet of this company that we are trying to solve the problem for. Balance sheet for 2 years, 2011
Oh,
and 2012.
excuse me. Are
Please.
you sharing? Because we still see the grades page. That's what I see.
Ah, yes, I do.
Me
Okay,
too.
let me reshare.
Okay, so it wasn't just me.
Okay, we can
Okay.
That
see it
worked.
now. We can see it
Can
now.
you
Thank
see?
you.
Oh, okay,
Yes.
fantastic. Okay, so this is the balance sheet for this company. And somebody is probably driving or something. There's some noise coming. If you can please mute yourself. Uh, George, I think that's coming from you. Okay, thank you. So this is the balance sheet of the company for 2 years, 2011 and 2012. And you already know you've taken two other courses in this area, at least two other courses, which are the prerequisites for the class. So I don't have to explain a balance sheet and an income statement, but just to recap, balance sheet is a statement for the firm where we record the company's assets, liabilities, and owner's equity. Okay, and assets must be equal to the sum of liabilities and equities, and that is why we call it a balance sheet. These two have to balance. If they are not, then it's not a balance sheet. So for example, these are total assets for 2012 of this company, and these are total liability and equity. And you can see those two numbers are the same. If they're not the same, then there is a problem with the balance sheet. Now, in the asset side, we have current assets, which include cash, accounts receivables, inventories, or maybe some other like marketable securities, some bonds or stocks that you've purchased for short-term holding. Those will be your current assets. Current assets are basically the ones that you use very frequently, and they will be converted to an expense or into another type of asset within 1 year. If an asset lasts for more than 1 year, that's called a long-term asset. In this particular business, we have some gross fixed assets. So these fixed assets basically are buildings and machinery and stuff like that. So, and they also have accumulated depreciation because these assets accumulate with depreciate with the passage of time. So we remove that accumulated depreciation. And this net fixed asset value is basically the gross value for which you purchased the assets minus the total depreciation, and you get the difference is the net fixed assets. That is the book value of your assets at that particular point in time. And total assets will be equal to the sum of the current assets and the long-term assets. Okay. So I don't want to spend a lot for some of you. It will be just too basic. But if you want me to go into more details or you have any questions, just let me know. I'll go into the details. But just to have a recap. On the liabilities side, we have current liabilities. So those are accounts payable, notes payable, accruals. Accruals are basically like, the salaries that accrue with the passage of time, bills, utility bills that accrue on a daily basis, accumulate on a daily basis, but you don't pay them on a daily basis. So you pay on monthly or maybe bi-monthly or 6 monthly basis. Those are accrued liabilities. And then the sum of all the current liabilities is the total current liabilities. Then you have long-term liabilities, which is most likely, the long-term debt that you borrowed from a bank or maybe through some bonds or other sources. So that would be long-term liability. And then you have common stock, and you may have preferred stock and some others. So common stock would be one is that like, at par where you issue this stock for, and there should be additional paid in capital. We're not going into those details. Retained earnings is basically the earnings that the company earns every year, but the portion that is not paid out to shareholders, but is retained by the business, it actually increases the shareholders' equity. So basically, the total shareholders' equity will, in this case, is the common stock the company that the company initially got, plus the retained earnings. That will be the total stockholders equity. And total liabilities and stockholders equity will be equal to the common equity plus the total debt. That is the right hand side or the other side of the balance sheet. Okay, any question here? All right. Then we have got the income statement where we have got sales and cost of goods sold. So this cost of goods sold is basically the direct cost of the sales. Like if you are a retail store, so the product that you are selling, the cost of those products is the cost of goods sold. And the price that you receive for those is your sales or your revenue. So your revenue, of course, is going to be greater than your cost of goods sold. And then you remove the other expenses, you get the total operating, expenses. In this case, when you sum these two, these are called operating expenses because these are utilized to operate the business on a daily basis. Buying, selling, paying salaries, paying bills, etc., etc. Okay. And then you have depreciation and amortization. Depreciation is for long-term assets, fixed assets, and amortization is basically for natural resources. That is, depletion and amortization is for intangible resources like a patent that you've purchased or a copyright that you have got. So those also depreciate with the passage of time, but that depreciation is called amortization. The concept is the same. Okay. Then you've got earnings before interest in taxes. So what you do, you take your total revenue and you remove the operating expenses and depreciation and amortization. Now you've got some earnings at this point, but this earning is before interest and taxes because you still have to pay your interest expense from this amount, and you also have to pay taxes. Now, interest and taxes are non-operating expenses because when you borrow money and you pay tax on that borrowing has nothing to do with the operations of the business. It can be your own money or it can be borrowed money. The business will still run in the same way. So that's a financial expense. That's not an operating expense. Okay. So when you remove the interest expense, what you get is the EBT, earning before taxes. So the I is removed because you removed the interest expense. That is earning before taxes. And then you apply tax on this EBT. In this case, our tax rate is 40%. So we multiply the EBT with 40%. We get the tax expense, and then the net income would be the EBT minus the taxes. So this is the net income, and that net income goes to the shareholders' equity. Okay. Now, if it is paid out as dividend, so it goes out. If it is not paid, it is added to the retained earnings. Now, remember, can somebody tell me why are these numbers in parentheses, and some of them are not?
Negative.
Negative.
Fantastic. So in accounting, when a number is within parentheses, that means it's a negative number. Or sometimes it's in red color. That also indicates a negative number. Or maybe both at the same time, within parentheses in a red color. So that is a negative number. Thank you. Here's some additional information that we'll be using in this assignment. Now, here in this case, I also have got the statement of stockholders' equity. But we probably don't need to go into the details. And we have got a statement of cash flows, but that is also not required for the purpose of the assignment. So let's save some time and jump into the assignment. Now, these questions are pretty much the same that you got in your assignment. So the first question is, what effect did the expansion have on sales after tax? So you've already, it's pretty much the same description that you've got. So let's not go into the detailed description. On the net operating working capital and net income. Okay. So one of the things that we would like to find is the net operating after-tax operating income. Now, what is operating income? The income that we get from our operations. So what are those? We get a revenue, we remove the cost of the sales, cost of goods sold. We also remove other operating expenses like salaries, bills, rents, etc., etc. And that income that we get is our operating income. Of course, we have now to remove other expenses like interest expense, which is still an expense, but it is not an operating expense. Okay, so when we talk about operating income, that's the income that the business receives from its operations. You may have other, like lots of debt, and you may be paying a lot in interest expense, but that debt or equity, that doesn't have to do anything with the operations of the business. It will still go on if it is equity financed or debt financed. So this EBT number on the income statement is what we call the operating profit. And when we multiply this with 1 minus t, that will be the after-tax operating income. In other words, when we remove the tax amount from the EBT, we get the after-tax operating income. Or in other words, in most cases, what we do in finance or accounting, we multiply EBT with 1 minus t, and that straight away gives us the after-tax operating income. That means like this number is when we remove the taxes. Now, where do we get this number from? This is the EBIT, and as I showed you above, this is from the income statement. So you go there to the income statement, and that is the EBIT, earnings before interest and taxes. And so then you have to remove the interest expense as well. And we know that the tax rate for this business is 40%. So 1 minus 40% would be basically 0.6. So that equals to 1 minus 40%, 0.4, or 40%. So 0.4. And that comes out to be 0.6. So you multiply this EBIT with 0.6, and that is your after-tax operating income. Okay, so that is for 2012. You can do the same thing for 2011, or in your case, you've got that for 2021 or 22 numbers. So it doesn't matter. The process is the same. Okay, now here's the next thing: net operating working capital. What is working capital? Your current assets are basically what we call the working capital, because that is the capital that you work with on daily basis. You've got cash, you've got inventory, you've got, all those current assets. So that's your working capital. And when we say net working capital, that is when you remove the current liability. So current assets minus current liability will be net working capital. All right. When we talk about net operating working capital, now this basically means the current assets and current liabilities that are part of the operations of the business. Okay. Now, For example, cash is an operating asset, okay? But if you've got lots of cash that is not being used in the business, you may probably put that in a savings account or somewhere else. That excess cash does not count as an operating asset because you're not using it in the business operations. In that case, you will be removing it from the current assets to get the operating assets. In your question, the scenario that has been given to you is that the cash is excess and is not used in operations. So what you do when you calculate this operating assets, you take the total current assets and then remove the cash, because the question clearly says that cash is not an operating asset in this case. So we take it that one. On the other hand, we take the operating current liabilities. And these notes payables are basically borrowing, short-term borrowing from a bank. This is not an operating liability, okay? Because it's your decision, you borrowed it, you may be using it for some other purposes, not in the operations. For example, you took some notes and you bought a machine with that money. So not necessarily is an operating asset. So you take the current liabilities and you remove the notes payable. So that gives you the operating current liabilities. All right. Now, what we do in this case, in this particular case, all the current assets are operating. So we take that number over here as the total current assets are the operating current assets. In your question, it says that the cash is not operating. So you will have to take the total current assets minus the cash to get the operating current assets. All right. And then minus the operating current liabilities. So what we do, we take the total current liabilities and subtract the notes payable from that, which is a bank borrowing, for example. So we go to the total current assets, okay? These are the total current liabilities. These are total current liabilities, and we remove the notes payables. The remaining amount is what we call the operating liabilities, all right? So now what we got here, we got the operating current assets and we got the operating current liabilities. What will be the net operating working capital? That will be the difference between the two. Operating current assets minus operating current liabilities. So here we go. We get that net operating working capital. Now, what does that number mean? This is the amount of money that is being actively used in the business, and this money is basically coming from either long-term borrowing or owner's investment. This $913,042. Okay, that is the investment, actual, capital investment in the current assets. You look like, the total current assets are about 2 million, but because part of that is financed through current liabilities, the net amount that is invested by the owners or long-term debt holders is about 1 million or less than 1 million. And that's what we call the net operating working capital. The question may be, you have to find the change in net operating working capital. In that case, you will have to find the net operating working capital for the other year as well. So this is for 2012 that we just discussed. You can use the same process to do the calculations for 2011. Okay, and we get this number. What will be the change in net working capital? Of course, the difference between these two numbers. That will be the change in net operating working capital. All right. Okay, so is everybody with me? Everybody here?
Professor, can we have this file loaded in the modules?
Yeah, I will post this.
Thank you.
All right. Okay. And let me know if I'm going into too much detail, because for now I don't really know what depth I need to go into, but I can go into any detail that you want me to go to. I'm just moving faster because I don't want to make it a bit too detailed if you already know a lot of that. Okay. All right. So those will be some of the questions that your assignment asks for. Change in net income, of course, that's very easy. Net income from 2012 and minus net income from 2011, you find that difference, and it's going to be that number. So this is the income from 12, that is income from 11. We just copied them from the income statements. You can go back, and I have made this equal to the net income of 2011, and that's it. And then I find the difference between the two. So no big deal over here. Okay. Now, this might be the part that some of you will get confused with. What effect did the company's expansion have on its free cash flows? Now, remember, one of your group assignment is also related to free cash flows. You will be calculating it. So it's good to know that formula. The formula that we use for free cash flows. And by the way, what is the free cash flow? What is free cash flow? Free cash flow for the business is you generate cash flow from your operations and you invest part of that in long-term assets. So your cash, some of your cash flow is stuck over there, and part of that is getting stuck in the net operating in the operating working capital. And the remaining cash flow is what we call the free cash flow. So let's say that you generated 10,000 from EBIT, like after tax EBIT, when you remove the taxes as well, $10,000. And you used 5,000 of that to buy an equipment. And you used 1,000 of that to increase your current assets. The remaining 4,000 is what we call the free cash flows for the business. Now that free cash flow can be used for anything. It can be used to pay out dividend, or maybe to do some more expansion or whatever, but that is what we call the free cash flow. Free cash flows is one of the valuation methods that we use when we find the value of a company. The company that generates a lot of free cash flow is considered to be a good company. Anyway, so the formula for free cash flow is that we take the EBIT and multiply this with 1 minus T. Now remember, EBIT multiplied with 1 minus T is what we call the after-tax operating income, right? EBIT is operating income. And when we multiply this with 1 minus T, that's after tax. Okay. And when you have that number, you add the depreciation for that year back to this number. The reason being is that depreciation is a non-cash expense. Okay, you bought a car and you calculated your 1 year's depreciation, $2,000 1 year depreciation, but you don't pay cash for that, right? It is a non-cash expense, but we still include that depreciation in our income statement because the government gives us, like, tax benefit on that. So it reduces our income and we pay less income tax, but it's actually a non-cash expense. So we add it back to the after-tax operating income. And then we remove the capital expenditure and any change that has happened in the net operating working capital. Remember that we just calculated the net operating a change in net operating working capital, this number. Okay, that's the change. And this delta sign over here, that delta means change. So whenever you want to denote change in something, that is what that delta sign. So change in net operating working capital. So what is capital expenditure? This is basically the amount of money that you spend on buying those long-term assets. Okay. So in order to calculate that number, there may be a number of ways. If you have the statement of cash flows, for example, here we have it. So let's go to the cash flow statement and we go to the long-term investment part. Here it says addition to plant, property, and equipment. So we added plant, property, and equipment, which are long-term assets. And how much money did we spend on that? We spent like $711,950 on that, which means that much cash was stuck in the long-term assets. So if you have this number, you can straight away get it from here. in your assignments, you haven't got the cash flow statement. So you have to go another way to find this number. Now, how do you do that? If you have the gross fixed assets, which we have over here with us, gross fixed assets, okay? We have those for the 2 years. So you can see that last year, our fixed assets were 491,000, and this year, these are about 1.2 million, which means we have increased our gross fixed assets. And of course, that means that we have spent money on this. What is the difference between the two? If you find that difference, gross fixed assets, the current year gross fixed assets and minus the last year, there is a 711,000. So that's the same number that we have got here in the cash flow statement. The only thing is that here it is represented as negative because it represents a negative number, a cash outflow. But that's just the absolute value of the gross, capital expenditure. However, in your assignment, you don't even have this gross fixed assets. You have net fixed assets. Now, what happens in the net fixed assets? We actually remove depreciation from the next assets. So what we do in that case, if you get the net fixed assets, you find the difference between the two net fixed assets values. So net fixed assets, that will be this number, net fixed assets, right? No, I'm doing the total assets. What am I doing? Yeah, correct. And minus the previous year's net fixed assets, I got this number. And then I take the current year's depreciation, okay? So what is the current year's depreciation? That would be in the income statement, because that is the depreciation for this particular year, depreciation expense for 2012. Remember that you do this for the same year. Don't get one number from one year and other numbers from the other. You may get confused with that, but okay. So then we add these two numbers. That will be the total capital expenditure plus this fail. And you see, these are the same numbers that I got. Okay, so there are different ways to get this capital expenditure. And basically what that represents is the total money invested in long-term assets. Any question on that? All right, all good. Then we go to see what we do next. Okay. So we got the capital expenditure, and then we add this with the net operating working change in net operating working capital. We have already calculated that number, which is this one, change in net operating working capital. So we just take the two numbers and add them. So let's see what we have here. What I've done here, in this case, I've taken these numbers from the capital expenditure from the cash flow statement. So you see, that number has been taken from the cash flow statement. But this is exactly the same number that I have got over here in this method or in that method. The only thing is that this number is a negative number over here, but I needed a positive number in my formula. So what I do is that I put, when I build my formula, I put a negative sign before that so that I can make it a positive number, you see? And then I add the net operating working capital, which is, where is it? Where is it? Change in net operating working capital should be this number. Okay. Yeah, change, that's this one, change in net operating working capital. All right. All good. Now, free cash flows would be, you just simply do this. This is EBIT, that is 1 minus T, 0.6. This is depreciation, which we already know from the income statement. And this is the capital expenditure and net operating working capital added together. Then we do this. So simply what we do over here, we take the EBIT and look at the formula. It is multiplied with 1 minus T, okay? and then we add depreciation, which is this number, and we subtract this number. All right, that is what we get. Free cash flows for this year are negative. Now it is a negative number. What does that negative free cash flows means is that this business is not generating any cash flows for us. It is actually eating cash from us. And what we do in that case, we have to manage that cash from external sources. Either we'll have to borrow or we'll have to issue new stocks or whatever we do, but that business is not going in a very good direction. Maybe it's like a new business, and it of course, new businesses need more and more cash so that it can start its operations. So in that case, that's fine. But if it is a well-established business running for many years and it is generating negative cash flows, that's not a good business. All right. Another question is the enterprise value added. Enterprise value added. So here's the formula for enterprise value added. We take the after-tax operating income and then we remove the cost of capital. Now, what do we mean by this enterprise value added? You've got an enterprise, okay? And where does the money come for this enterprise? Either you invest your own money or you borrow it or you get it from shareholders. Let's imagine that you've borrowed $1 million at 10% interest rate for the business, okay? So how much is the cost of the capital that you're using? $1 million. That's the only money that you're using. You're not using your money. $1 million at 10% rate. What is your annual tax amount? 10% of 1 million is 100,000, right? Am I right? Okay. All right. So my cost of capital is $100,000. If I generate $150,000 from this business, then I have generated like 50,000 extra. That 50,000 extra means that I have added a value to the enterprise. And how much value have I added? 50,000. If my cost of capital is 100,000 and my EBIT into 1 minus T, after tax operating income, is also 100,000, then I did not add any enterprise value. What if my EBIT into 1 minus T is 50,000 and my interest expense is 100,000? That means I have eroded $50,000 from the enterprise value. Okay, so the bigger the enterprise value, the better the business. Okay, now how do we do that? We already know how to calculate EBIT into 1 minus T. We did this so many times before. So we can simply take that number or you can redo it, okay? So we take EBIT into 1 minus 40%. Anyway, now for this part, we need to calculate the total invested capital, okay? And total invested capital is basically what we have to calculate. Total invested capital is actually the investment that is made by the owners, the stockholders, or the banks, the debt holders, or any short-term liabilities. So any investment by investors made in the business is what we call the total invested capital. And every investor is expecting a return on their investment. So in this particular case, the after-tax cost of capital is 10%. Like all of these investors are expecting on average, like, 10%. We'll be talking about this, cost of capital later in a separate chapter. But for now, we just assume that it's 10%. How do we calculate our total invested capital? We take the notes payable, which is a borrowing from a bank. A long-term debt, it may also be borrowing from a bank, or it could be bond issued or whatever, but it is long-term, like many years borrowing. And then plus common equity, this is the investment by the common stockholders in this particular case. So we add these together, okay, to get the total invested capital. Notes payable, this comes from the balance sheet, current liabilities portion. We already know that. That's, notes payable under the current liabilities comes from there. And a long-term debt, that also comes from the balance sheet under the long-term debt. If you want to just double check it, here you go. That's the long-term debt, long-term borrowing. And then we take the common stock, which also comes from the balance sheet, and that will be the owner's investment in the business. Here you go. Total common equity is the sum of the common stock plus retained earnings. These numbers added together, okay, it gives me the total invested capital. And then I multiply this total invested capital with 10%. So that will give me my total interest expense, or whatever you may call it. That will be the amount of money that investors expect in return for investing in the business. So we got EBIT into 1 minus T, and then we have got total invested capital multiplied by the 10%. So here you go. Total invested capital multiplied by 10%, which is the after-tax cost of capital, and that is what the investors expect. Now we see our EBIT is a negative number, which means the business lost money. And at the same time, investors are expecting a return of 185,283. You see, that is what they're expected. Or just imagine if this is interest amount that needs to be paid. We lost this much money and we have still to pay this much interest. That means we're in a big trouble. The sum of the two is a bigger negative number, and that is negative $263,852, negative number, which means in this particular year, the business eroded $263,852 of enterprise value. That's not a good business, okay? We're eroding enterprise value. Okay, now, if there's any questions, just let me know. Otherwise, I'm jumping on to the next one. Total market value added. Now, when we have the total common equity, that is the book value of the equity, the actual investment that the owners have made, and plus the retained earnings. Okay. But the market value of your company might be different. If you are doing a good job, let's say you started a business and you have invested $1 million. All right. But after a couple of years, your business is doing really well, and the market assigns $5 million value to your business. What that means is that the market is willing to buy your business at $5 million. It means that you have added a market value of how much? 4 million. 1 million is your investment, and the market is valuing your business at 5 million. So you have added 4 million market value. That is what we call the market value added. Okay, so how do we calculate the market value? We take the share price from the market and multiply this with the number of shares. In this particular case, I think we have got 400,000 shares or 4,000 shares. Where's that number? And we've got the share price as well as the additional information. So here's the share price, and that is the number of shares outstanding, 100,000 shares. We multiply these two, and that's the market value of the company. This market value, by the way, is also called the market capitalization. That is the value that the market gives to the company. So, for example, what is the market capitalization of? Can you tell me any company's market cap? All right, NASDAQ has been doing well over the past week, and it's started a good week today. Tesla is going to announce its earnings on Wednesday, so let's see what happens to the stock price. But let's see the market cap of Tesla. And if you go to Yahoo Finance, you will find it somewhere here. Here you go. Market cap of Tesla is about $454 billion, which means that the market is valuing this company at this price. And that price might be different from the book value of its assets, and that means the company is doing a good job. Just to just to show you where to get those numbers from. So here you go. This is the market value or the market capitalization of this company. And this is the book value of common equity. This comes from the balance sheet. So straight away, the equity value, total common equity, comes from the balance sheet, total common equity. Now, when you find the difference between the market value and the book value, that will be the market value added. And you can see the company has eroded market value. You know, like people are not buying this business even at the money that the owners have invested in it. The owners have invested about 492,000 in the business, but the market is willing to buy this business at only 225,000. So it is less than the book value of equities, and that means this business has eroded a lot of market value. All right, so that's it for the assignment. I was a little quick on this, but just wanted to make sure that we go through this and I can answer your questions. Any question, comment? All right, guys, are you there? Samir, please.
Yes, I had one question, Professor. Thank you so much for walking us through all the details. It was very informative. In our assignment, all the numbers are in millions, and the number of shares is, I believe it was 4,000 or something like that. So is that also in millions, or that's actual 4,000? That's it.
Well, I will have to check that, but there should be details should be given. That should also be in millions.
That should also be in millions. Okay, all right.
But
Just wanted to confirm.
Yeah,
I was stuck with that CapEx thing, but thank you for explaining, and I can complete that portion now. So
all right, fantastic.
thank you so much.
You're welcome. Anything else? Anyone? Mark?
Is the market value always multiplied by the total number of shares outstanding, or is it adjusted for the float? Let's say there's an insider that is not going to be able to sell, or does that depend on where you get the information, like on a Yahoo or a Bloomberg?
Well, so those should be the number of shares outstanding, which are already in the market. But the easiest way, like if you want to get the market value of a company or the market cap, you can get it from Yahoo Finance, Google Finance, Morningstar, lots of websites that you can go to and get lots of information. And I just wanted to be quick, didn't go into more details over here, but you can get lots of information from Yahoo Finance over here. Like, for example, the this is like the market information, market cap, and what is the beta, which is actually the risk of the company, price earning ratio, the earnings per share, and lots of other information that you would like to look at. But if you want to find some other financial information, for example, you want to look at the company's balance sheet. So here's the income statement, and it's just like very shortened form, so you don't see lots of details because you cannot have all the numbers over here. But there you go. Here's the income statement of the company. If you want to look at the balance sheet, there's the balance sheet of the company. You see. And that's like, invested capital that we just earlier talked about, working capital. We talked about net operating working capital, but they're talking about working capital over here. So those are different numbers that you can find and you can calculate. And here's the common stock equity. So those numbers can be obtained from here. If you want to have a look at the company's cash flow, here you go. You can look at the cash flow. But we're not going into those details at this point. But yeah, you can get all that information from these different sources. And we'll be looking into much more in-depth analysis of the companies and calculating those ratios and what they mean and how do we use those ratios to make our investment more informed investment decisions. But yeah, I hope that answers your question. Mark.
Yes, thank you.
Yes.
You're welcome. Anything else? me see if there's any question in the chat. Okay. Okay, so no special question over here. Okay. So if that's it, we'll wind up the session. I really appreciate you attending the class today, and I would be very happy if you can attend the future classes as well. Just to let you know, I will be traveling to attend to speak at a conference in Ankara, Turkey next week. So I will be actually in transit at that time. We will not be able to have a class next week, but I'll be available on email, phone. Just let me know, and I'll be happy to jump in. Susan, you want to ask something?
I was just gonna say safe travel.
Thank you very much. Appreciate that.
Safe travels, Professor. Thank you so much for the class today.
Thank you.
Thank you.
I'm looking forward to working with you. Just to let you know, one more time, I'm here to help. Okay. I'm not here to penalize anyone. I want everybody to succeed, but you have to reach out to me. If you're stuck, if you're doing fine, I mean, doing well, that's fantastic, great work. You can help your other classmates as well. But if you're stuck and you need help, just reach out to me. Okay, and I'll be happy to help. Thank you very much. And
Thank you. Thank you.
good night.
Yeah, thank you, Professor. Thank you.
Thank you. Bye.
Thank you. Bye-bye.